Good morning, everyone, and welcome to this morning's webinar brought to you by KPMG. We hope you had a great summer, and judging by the big volume of people that signed up for today's webinar, summer mode, I think, is deactivated and we're turning a chapter into the autumn, and people seem to be looking ahead to the new financial reporting year-end season. And my name's Conor Moroney. I'm a director in KPMG's asset management practice. I've been with the firm for the past 12 years or so. Today, my colleagues and I are going to give you an insight into the reporting and regulatory topics as they apply to the asset management industry, covering some of the more immediate term, but also the medium-term outlook. So let's take a look at what's in the agenda today. So this morning, the first 20 minutes or so are going to be a session by me just giving you an overview on financial reporting outlook as it impacts the asset management industry. Then my colleague Déirdre Finn will bring you through an overview of regulatory hot topics and priority items. And then finally, Sarah Moran will give you an update on ESG reporting, specifically focusing today on the Sustainable Finance Disclosure Regulation, or SFDR, as it's more commonly known. So without further ado, we'll jump into our first section of the presentation, and that's financial reporting updates. So depending on what type of entity you are, this is busy or not. So thankfully for funds in the asset management industry, the immediate to medium term outlook is relatively neutral and calm. But for other entities within the industry, like, for example, fund admin companies or fund managers, it might be a little bit more turbulent depending on what financial reporting standards you apply. So today's session will give you an overview of changes that the FRC have made to IFRS 102, being the financial reporting standard that certain local asset management entities in Ireland and the UK use if they're not applying IFRS. We'll also, at a very high level, give you an update on some of the changes that has been made to the UK Code of Corporate Governance, and we'll give you the reasons as to why we're doing that. And then also, we have clients or market participants joining us today who prepare financial statements under IFRS. So we'll give you a sneak preview as to what IFRS 18 looks like, and in particular with the aspect of asset management in focus. And then along the way, we'll touch on some common themes and regulator findings as they apply to what we're speaking about today. So our first update is in relation to FRC amendments made to IFRS 102, which is arguably the most significant change that has been made to these standards since their implementation back in the mid-2010s. And what we're looking at today is essentially two main big changes. Those are new standards on leases and revenues, which don't necessarily have an impact on fund accounting, but will have implications for those asset management corporate entities that have those on their balance sheet, or obviously, for example, asset management companies that are revenue or fee generating. So the impact here is from accounting periods beginning on or after 1 January 2026, with early adoption permitted. So let's take a look at what those mean. So this slide is there not to scare you, but just to give you an overview of the key changes to the leases standard and the revenue standard. And while we don't propose going through this today because it's not applicable to all people joining us today, it does have an impact on those preparing financial statements for asset management corporate entities. And essentially what FRS 102 is doing here is bringing these amendments more in line with the recent amendments made to IFRS 16 and IFRS 15 by the IASB. And so what we're seeing is more of a convergence of standards across different accounting reporting issuers. So because funds have no leases, and I suppose the main impact here for entities in the asset management sector is on revenue, I don't propose stepping through the detail of these changes today, but just to let you know that they are out there and that this slide deck will be available afterwards if you want to peruse the detail and see how it impacts you. So the main impact across all asset management entities will be to update your revenue accounting policy in year-end 2026 to apply to the nuances of the new standard and not rolling forward previous accounting policy. So changes that have been made to FRS 102 that do have a wider impact on the asset management industry is changes that have been made to Section 2A regarding fair value. And this essentially is bringing FRS 102's definition and standard more in line with IFRS 13. So for funds or asset management entities that hold primarily level 1 and level 2 assets or liabilities, the impact is a little bit more limited. It's just updates of definitions and guidance. And where the real impact here is for those entities or funds holding level 3 assets or liabilities. And we'll step through on the next slide what that looks like. So this slide here aims to give you just an overview of those changes. And essentially what's happening here is a convergence of the IFRS 102 standard with the principles in IFRS 13 in as far as possible. So the first key change to the standard is giving more guidance on the application of fair value principles, which aligns with IFRS 13. And essentially it's clarifying how entities should value assets or liabilities traded in an active market. And it's also giving some value around the edges on what to do for the fair value of non-financial assets, say, for example, property, which could then have an impact on property funds. Other clarifications added to the standard are giving, I suppose, more guidance on what market assumptions are. So as we know, fair value measurement is all about what someone is willing to buy or sell an asset or liability for. And the standard is being implemented with more guidance on what factors to consider when determining fair value. And then finally, the key change really in terms of the update to this standard is the alignment of the fair value hierarchy disclosures more akin to what we see under IFRS 13. So one of the big differences historically has been for level 3 assets or liabilities under IFRS 102, there wasn't as much direct guidance on what you must disclose. But that's now changing from 2026 onwards, and the gap is closing, whereby an entity or a fund that has level 3 financial assets or liabilities is required to give an overview or disclosure of the valuation techniques used in the valuation, in particular giving sensitivity analysis for significant unobservable inputs where applicable, and also disclosing any changes in valuation approach from year to year. So that's a significant change that will impact issuers under IFRS 102. If I might then bring your attention to some of the other changes that have been made and focus on just two of them that again have an impact more on the asset management industry, and that's on changes in relation to what's required on disclosing whether or not an entity is a going concern. So the impacts essentially are that entities now need to make a positive statement noting that, for example, a fund's financial statements are prepared on a going concern basis. And that's a direct requirement in terms of what was there in the standard currently, which isn't as direct in terms of instructing you on what to do. And then the final key change for IFRS 102 issuers, this is for first-time adopters. And I reiterate, just not to panic people, this is for first-time adopters. So if you have a current accounting policy, you can continue that forward. And what this essentially is doing is restricting the option that entities had when applying IFRS 102 for the first time when recording and measuring their financial instruments. Historically, or as we sit here today, you have three options. You could apply section 11 and 12 of IFRS 102 and account for them and measure them using that. You could use guidance from IFRS 9 and account for and measure them using that, or you could use IAS 39. And so in line with what's happening in IFRS, the option to use IAS 39 from 2026 onwards is being removed. So your options of 3 as we sit today are now down to 2. And I reiterate, that's for new funds or new issuers under IFRS 102. If you are continuing forward an accounting policy of using IAS 39, that's no problem. So there are the accounting changes brought about by the FRC, some more significant than others, depending on what kind of entity you are. What we want to touch on now is just to give you a flavour of some of the changes that the FRC have made to the UK Corporate Governance Code. So why are we bringing you those today? So as you know, the UK Code applies to all issuers with a premium listing in the UK, but can be voluntarily adopted by others. And the reason we raise this with you today is because this code is essentially driving changes that are made to other more localized codes. Say, for example, you have a local funds body that has a corporate governance code or a local stock exchange, etc. They all look to changes in the UK Corporate Governance Code for guidance on essentially what they should change next. And so, for example, the Euronext, which is the stock exchange amongst various countries in Europe, is deciding or is currently deliberating about developing their own corporate governance code. And while those are still in the early stages, it has flagged that if it was to develop a corporate governance code, it will look to the UK Code of Corporate Governance for guidance on its provisions. And so this would impact, say, for example, listed funds that might be listed on some of those exchanges like exchange-traded funds. So the important thing to note is that it's not a stick to beat issuers with. There is the overlying principle of comply or explain. So you should try and comply with the provisions of the code, and if not, explain why you couldn't or why you didn't in a particular reporting period. And so what I might do is just give you a flavor of one of those changes, which, as it was announced, has made some of our clients who do issue their financial statements with disclosures in relation to the UK Corporate Governance Code, it's made them think twice about the impact of this and what processes and controls they have in place to allow them to comply with the new required disclosures under the code. So the existing requirement forward is that boards are expected to monitor the company's risk management framework and internal control, and to carry out an effectiveness review essentially on an annual basis at least. And what's being added to that requirement is this new provision with the star on the screen there beside it, provision 29, which is now additionally requiring boards to provide a disclosure in their annual report of how they have monitored and reviewed the effectiveness of internal controls of the entity to which they're board members. Also, they need to disclose in the annual report a declaration of the effectiveness of material controls at the balance sheet date, and also, and maybe more significantly, a description of any material controls that didn't operate effectively at the balance sheet date, including any actions that it plans on taking to fix that ineffectiveness. And as well, on top of that, or maybe linked to that, for those, as you move forward through reporting cycles, for those controls that you disclose as being ineffective in previous years, what have you done to fix those, and are they now effective? So companies that we deal with, whether it be asset management companies that are applicable, or sorry, that do apply this code, are thinking twice and saying, do they have the processes and governance structures in place to allow their boards to sign off on these disclosures or to make these disclosures at a particular reporting date? And so that's just a flavor of some of the large scale changes that are being made to the code, which might filter through then into some of the more voluntary codes that we see adopted across the asset management industry. So what I might do then is just conclude the FRC section or update with an overview of what we think is a really useful tool. So KPMG are often asked for illustrative disclosure on what, for example, a good example of a judgments and estimate disclosure or a fair value disclosure or financial instrument risk disclosure is. And oftentimes we point to our illustrative disclosures, but those are, I suppose, quite high level and boilerplate and almost trying to find a one size fits all. But really where you find some nuanced disclosures in real life examples is in this report that's issued from the FRC annually, where it does a thematic review of issuers under its own accounting standards. And it pulls together into this report real life examples and lists the companies of where good disclosure has been made on a particular topic. And so this is a useful reference point for you if you're looking for some inspiration on what you could or should disclose in your financial statements. And essentially, you won't be surprised here to learn that what good looks like is not boilerplate language of pages and pages. It's short, snappy, but targeted disclosure on facts and circumstances applicable to your entity. And that is what we would encourage as you consider updating or changing some of your reporting disclosures. So the next section of the financial reporting update looks at changes that have been made by the ISB and the introduction of IFRS 18. So this is quite a significant change coming down the tracks, and it's replacing IAS 1, which is the presentation of financial statements standard. So the items highlighted on this slide, the pink stars, are probably those elements of the new standard that have the most significant impact on asset management clients. And essentially the takeaway from today is that there are three key impacts for IFRS issuers. Firstly, there's a more structured income statement. Secondly, there is now the requirement to disclose and also to have audited management performance measures, and we'll step through what those are in a second or two. And the final key change is that there's greater guidance given on what you can aggregate or what you should disaggregate when you're labeling things as other in the financial statements. So when are these effective? They're effective from 1 January 2027 onwards, but in that period, you're also required to give comparatives. So essentially from 2026 or maybe towards the end of 2025, you need to start thinking about what are those key impacts and changes, and will you be in a position come 2027 to disclose? So let's take a step through some of the key changes. So the first one here is in relation to the introduction of management performance measures. And these at the moment are known as alternative performance measures, or APMs. So what are they? If you open up the annual report of any listed company, and I guarantee you on the first 1, 2, or 3 pages, there is a list of stats that management of that company believe is what the reader of a financial statement should use to understand its performance in the year. And oftentimes, and much to the frustration of regulators, those stats don't tie through to the audited numbers or the IFRS numbers in the financial statements in the back half of the annual report. And so this is an attempt to tidy all that up and to bring it under the remit of auditors then to opine or include that within their audit opinion. Whereas historically, sometimes some of them are in and some of them are not. So from a fund or an asset management perspective, what are these? Well, it could be as simple as something like net asset value per share, because that's a non-IFRS metric. But then it might get a little bit more complicated or nuanced if you have adjusted net asset value per share or total return on investment or a performance tracking statistics or an investment gain or loss that's adjusted for a particular item like FX, for example. So essentially anything that's not an IFRS measure is deemed a management performance measure and falls under this remit. So what does that mean? Well, the ISB released an illustrative disclosure and trying to, I suppose, show people what's required. So in this example here, you can see that management of this entity wished to disclose a non-IFRS management performance measure being adjusted operating profit. And you can see that this is then reconciled back to the IFRS caption being operating profit. And so you're supposed to provide the reconciliation, and then you're also supposed to state why the fund manager or the manager of the entity believes that this is a view of the fund's performance in the year. And it should explain why this management performance measure provides useful information to the reader and also how it's calculated. And this should be consistent year to year. And if there's an instance whereby the preparer of the financial statements changes a particular management performance measure, it needs to note this change, and it also needs to explain what changed and how it was calculated. So there's quite a bit to consider here for preparing financial statements for funds and other asset management entities from year end 2027 onwards, but also having in mind that 2026 comparatives are applicable. The second key change is tidying up what the income statement looks like. So the face of the income statement will now have two newly required subtotals on its face, being operating profit and profit or loss before financing and income tax. And how this will apply to funds specifically or asset management companies, obviously this is an operating entity, it's quite straightforward, but I think market practice will have to develop as to what's acceptable or not for a fund income statement. And the second key change to the income statement is that now income and expenses are required to be classified into three categories. Depending on a company's main activities, these will be busier than others on the income statement, but those three categories are operating, investing, and financing. And those of you with a sharp eye will know that those are the three same categories that the cash flow statement is required to be split up into: operating, investing, and financing. So it's bringing in line the cash flow statement with the income statement to try and give a clearer or better view of the performance of an entity within a year. And then the final key change brought about by IFRS 18 is the introduction of guidance on what you can and cannot aggregate as other. So say, for example, throwing things in as other income, other expense, other asset, other liability, etc. So what IFRS 18 is trying to do is to give guidance on how to tidy up the financial statements. So it's giving more defined roles for the primary statements, i.e. they're there to give a useful structured summary of the activity during the year and the company's assets and liabilities. The notes then are there to provide other material information. And then anything else that you want to collate together as other can only be collated together as other if it has shared characteristics. For example, it's of the same nature, it's of the same size or function or geographic area or regulatory environment, etc. So this is just giving more structure on what can and cannot be included in other. There are other changes brought about by IFRS 18, but those are the three main ones. There are some changes on tidying up what can and cannot be disclosed and where it should be disclosed in the cash flow statement, but I don't propose going through that now today. But essentially for you, the takeaway from today is there are three takeaways. There's a more structured income statement. There will be a requirement to disclose and have audited any management performance measures, and there's greater guidance on what can be disaggregated or not in financial statements. And I might conclude the financial reporting section then on just trying to tie this together. So on the slide here is the most recent publication from IASA, which is the Irish accounting regulator, but every accounting regulator across Europe and likely the world, publishes an annual review or kind of findings document of what they've looked at in the last year and what they see as being the important issues that financial reporting preparers should, I suppose, take note of for the next year. And highlighted here are some of those key observations. This document is about to be soon out of date, because I believe next month they're releasing their 2024 version. So that's why I don't really want to go through today the contents of what's in here, apart from to bring to your attention two key items within it to try and tidy up or bring together some of what we've been speaking about this morning. So if you look at the top left part of the slide, you'll see that the focus here for this particular regulator has been, amongst many other things, but a focus on how financial instruments are disclosed, as well as fair value reporting is disclosed in the financial statements. And that essentially then is driving some of the changes that have been made, for example, to IFRS 102 and also in the past IFRS 13. And then also, if you look at the bottom left part of the slide, you'll see here, and probably in every other regulator around the world, findings on alternative performance measures, which are a feature in almost every year's, has been reported for many, many years, and it's the driving force behind the introduction of the MPM provisions within IFRS 18. So it's all intertwined in terms of the standard setting agenda and the regulatory agenda. So that concludes my part today on financial reporting updates. Just to flag to you that KPMG has an accounting advisory team. So if there are any questions that you're grappling with, if you want to learn more, if you have a question big or small, or you need help with an issue, we have an accounting advisory team led by Terence, who are more than happy to spend a phone call with you and to see if there's something that we can help you with. So reach out and we're delighted to help you learn more. So now that concludes the financial reporting update section of the presentation. I'll hand over to Déirdre Finn for the regulatory update.
Thanks, Conor. Good morning, everybody. I'm Déirdre Finn. I'm a director in our regulatory and consulting practice here in KPMG Ireland, and delighted to be with you this morning. So I'm going to take you through some of the central bank focus, I suppose, on your sector. And starting with the risk themes, central bank come out regularly on an annual basis and they release their risk themes, which gives regulated entities, I suppose, an indication of what their focus will be on, and then helps you as regulated entities prepare for maybe some questions and deep dives or even on-site inspections that may be the focus of the year ahead. So, I suppose, given that Central Bank of Ireland have a financial stability mandate, they are focused on macroeconomic and the geopolitical environment, with changes obviously coming out of a quantitative easing regime into central bank rate hikes and now central bank cuts. And we'll see what the Fed does later on this week. They are looking, I suppose, at the impact of inflation and interest rate rises on the real economy and how that filters through then to regulated entities, ultimately to end consumers, both on the wholesale side and on the retail side. And that, I suppose, feeds then in through the second risk area, which is very pertinent for your sector, and asset valuation and market risk, and how some of the real economy, interest rates, inflation impacts on asset valuation. Obviously very important in your sector. That's how you, in essence, I suppose, value some of your value from the investment and portfolios in particular. So how that flows in then to some of the risk that they want to focus on the regulatory side. As we saw, some of the crisis, I suppose, in the UK on the back of LDI, they are looking now and increasingly looking, I would see, on liquidity and leverage risks as we come out of a regime of quantitative easing, a lot of excess liquidity, you could argue, with interest rate impacts, with inflation impacts, then how is that impacting itself on liquidity, both in terms of consumer availability, but also liquidity on the markets and depth of liquidity in some of the markets. And then that feeding through again into credit and counterparty risk. So focus on areas, especially at the moment, credit risk arising from maybe the valuation of commercial real estate. How is that impacting on credit risk within portfolios and within asset management in general, as well as obviously quite a focus on that in the banking sector as well, as you can imagine. So the observations here, which they put under risk theme A, feed then into some of the regulatory agenda that they have and how they are regulating and setting their regulatory agenda for entities within the jurisdiction that they supervise, and how the regulated entities themselves are responding to some of the changes that are emanating from risk theme A. So a key focus for the central bank over the last several years, I suppose, has been consumer and investor detriment risks. We've obviously got the upcoming change and update to the Consumer Protection Code, which is expected next year, and how that's going to impact and increase, I suppose, the focus on consumer detriment and the focus from central bank and a regulatory on how regulated entities are treating consumers, keeping them fully informed, having the reduction of consumer detriment risk at the fore at both board and executive level. That's also, I imagine, for your sector feeding through with the maybe increased focus, I would say, from Central Bank of Ireland on the wholesale conduct side, and how they are looking at aspects like market abuse and how they have upskilled, I would say. I came from the regulator to KPMG about 2.5 years ago, and certainly in my time in central bank, I saw quite a build out of some of the wholesale conduct areas within central bank. So that is definitely a focus. And then operational risk and resilience. We saw that as a sector, as a globe, I suppose, I think we responded well to COVID, but as a sector, the financial sector responded very well to COVID and the operational risks and the resilience that was shown. So I think that, in essence, I suppose, proved some of the resilience within the system, but central bank continued to be focused on this, especially, and we'll deal with Dora and in a few slides, especially as we get into more of a connected world, a big data world, cyber threats being more of an issue. How are firms resilient, and how are they responding to that? So we've certainly seen a big build out and focus on this area within the central bank, and not just Central Bank of Ireland, I would say probably central banks globally and regulators globally. Then it's the bread and butter of regulators to look at risk management practices, how risk is transferred within entity, outside the entity, maybe if you are a subsidiary of a global entity, how that risk transfer is happening back to the parent, or how it's happening across borders. So as I say, this is always the bread and butter of regulation, understanding how risk management is identified and managed within regulated entities. And then the other area that I think they're building out, and I'm sure you're feeling some of the heat of it and some of your regulated entities as well, is the world of big data. Ensuring that not just from a management information, so that the MI that's getting to boards, that's getting to Exco, that helps inform you to run your business, but it's also the data that's going into central bank, the amount of data requests that they have probably seen, or that you've seen from them, just trying to understand and piece together more MI themselves on the regulated data or the regulated entities, and then using that data to inform themselves from a sector view. Central bank are very good at that, actually, and it kind of feeds into their mandate, we'll say, under risk theme A as well, financial stability. They do drive an awful lot of economic research. So a lot of the data that you submit goes into the economic research. And in this big data world, they want you to not just manage it, not just ensure that you don't have deficiencies or inaccuracies in your data, but that you're also using it to make better informed decisions. Again, looping into that consumer, so making sure that you are ultimately providing the service, the regulated service, in an appropriate way. And then the next column there looks at risk theme C, and these are the longer term structural forces that are at play, that as they do horizon scanning, as they see the environment out, and Sarah is going to speak in a few moments about climate and sustainability, environmental related risks. You will see from Dear CEO letters from industry communication that this is certainly getting a lot more time from regulators, and they want to see implementation plans, yes, but also the embeddedness of how you are looking at sustainability, how you are embedding climate and environmental related risks within your risk management and core to your business. Financial crime risks are, as we see, again, that interconnected world, big data, a lot of, we all carry a device now that has us completely connected with the rest of the world. So as financial crime unfortunately increases and gets more sophisticated, how are firms managing that? I think over the next several years, we'll see the introduction of the Anti-Money Laundering Agency, AMLA, within Europe. And whilst it may not necessarily be an immediate impact on your sector or your regulated entity, certainly as that's put into place, as level 1 text is pulled together from a European level, that will start to filter down into regulated firms. So you will probably see a little bit of an increase in focus from anti-money laundering division within central bank, be that in a thematic across the sector or be that entity specific. And then the last bit, and I think probably as I look back over the last decade of financial regulation, I think we were very focused globally, and especially here in Ireland post-crisis, on the financial resilience. And then we moved into a little bit of the operational resilience. That's where DORA and operational risk resilience focus has come from central banks and regulators. And now we're feeding through, I think, into the strategic risk, that they are getting more and more focused on having viable, sustainable, profitable business models in place that can continue to serve the economy and continue to serve consumers. So those strategic risks, what's coming down the line, and how can we, as we look at innovation, as we look at digitalization, how can we prepare for that, both as a competent authority, but also as a regulator. So I would note that these risks are not ranked of equal importance by the central bank, but certainly you will probably see these thematically come across in your communications and interaction with them. And then if we look through 24 and 25, Ireland is the largest hub for investment funds globally. We host ETF and MMF sectors in Europe. And I think it is getting an increasing focus, regulatory focus, and I think that will continue from central bank. If anything, I see the prioritization maybe increase on the wider asset management sector from a central bank perspective. And they have identified some key priorities. And I suppose what this means for you is you look down through some of these 8, the focus on prospectus applications, fund applications, the completion of SFDR. They're going to participate in ESMA's depository peer review. They've got thematic reviews and pre-trade control frameworks. Looking at EU green bond authorizations and post-authorization findings. They're doing sectoral and thematic assessments on the completion of the ESMA Common Supervisory Action and SFDR. They're looking at AI and the related governance processes from it, from a conduct perspective, and they're looking, to identify and pursue instances of market abuse. And as you kind of hear some of those priorities, I suppose what that means for regulated entities, I would see, is an increase in engagement across these areas. So central bank may, as you interact with them, be it on an annual basis or a more regular basis, they may be asking you across these areas what you're doing, how you're responding. And also, it may mean an increase in some of information requests to you around these areas. It may also mean an on-site inspection or a thematic that they're doing. They may do a sector-wide thematic. That might mean, a suite of information that they request for you, and they do that on a desktop review, or it might actually mean that they're out with you in your entity on the ground for a day or two, understanding across some of these areas how you are implementing it in your regulated entity. And with central bank, it's always key, I suppose, to have evidence of it. So they will look, don't just tell us, show us. Don't just tell us about the implementation plan and the project plan that you have, but give us evidence of it being embedded in your entity. So give us evidence of where it's discussed at an executive level, where it's been presented to the board, what challenge has been or discussion has arisen on the back of it, and what decisions are making, and the governance around those. They're very big on governance, obviously, as you can imagine. Being a regulator. So then turning, I suppose, to how we would see some of the topical regulatory issues and what we are working with clients on at the moment across the dial. Primacy of the local entity is always going to be very important to central bank, looking at the governance, looking at the outsourcing arrangements, ensuring that the local entity has full control over what is happening within the entity itself. Decision making is not happening external, that where is outsourcing arrangements, that they are appropriate, they're documented, there's service level agreements, there's KPIs in place in order to monitor them, and that key is that there's not an over reliance. Whilst outsourcing is just a factor of business, but there's not an over reliance on the outsourcing arrangement. So I'm sure you've had interaction with that, given the central bank guidelines on it. Individual accountability framework I'll deal with at the moment. Spoken about the changing macroeconomic environment, retail investor protection, again, dialing up some of the focus on that from a regulatory perspective within the consumer and conduct pillar of central bank. Technological, digital and cyber risks. I'll deal with Dora in a moment, and then Sarah will talk about sustainable finance and climate risk. So as we look across the landscape, there's quite a lot going on. There's quite a lot of diverging, from governance risk management all the way through to how do you deal with sustainability and the retail consumer. So quite a lot of topical issues that we would see, and like I say, that we're working with clients with at the moment. Then if we look at the individual accountability framework, this is one of, I suppose, two bigger pieces of change that are coming within the regulatory landscape and have come for a cohort of firms from the 1st of July this year and the 1st of July next year for INEDs and non-executive directors. But this forum, SEER, forms part of the wider IAF that Central Bank have introduced, similar as those of you that are familiar with the UK senior management regime. Managers regime is very similar principles. And the big difference is here, I suppose, in some of the things as you come into scope for it that you need to ensure that you have in place are a very clear allocated responsibilities across all of your PCF suite. So this starts to bring into who is responsible for what. Are they making the appropriate decisions on it? Are they on the proper committees and fora? And are they empowered to make decisions that they are within their prescribed responsibilities? And the inherent responsibilities that are inherent to a particular role. And then there may be other responsibilities that your firm applies to PCF holders. All of this needs to be very clearly articulated, very clearly documented, and available for evidence to the central bank. And then with that, a management responsibility map. So understanding the overall governance arrangements, it must be kept up to date. It must be retained for 10 years. So we're working with clients at the moment, like I say, to put a lot of this in place. Some sectors already it's come to pass for them, and they've already gone through this. Others are starting their preparations for it, and having that documentation in place, having it properly approved, and understanding where it is and how you can present it to central bank. So these statements of responsibility that each individual PCF holder is very clearly defined and set out what their responsibilities are. And then obviously, with the introduction of IAF and SEER, those responsibilities come, the accountability that comes with those responsibilities is pretty significant under the regime. So turning then next to the other area that I'd mentioned that, again, we're working with a lot of clients on because it is a reasonably big change within regulation is DORA, the Digital Operational Resilience Act, not the Explorer, as we like to joke with clients. And this brings a regulatory framework for a digital operational resilience that firms are going to be subject to. And it's put in place so that firms can withstand, respond to, and recover from all types of ICT-related disruptions and threats. And it forms part of the wider EU digital finance package. But it's put in place to ensure resilience of financial institutions and the infrastructure. So ensuring that if something does happen, they're at the core trying to minimize harm to consumers. And obviously for a regulated entity, ensure that regulated entities can continue operations. So trying to strengthen that oversight and make sure that within the wider scope that these third parties come into scope now under DORA, and it's wider than just, we'll say, your traditional maybe banking and MiFID firms. It is a much wider piece of regulation. They're trying to raise this awareness of ICT risk and make the resilience much make firms more resilient to face off against these issues. So the clear priorities you'll see there, and that the areas, the key elements of the Act are governance and risk management, ensuring that you have incident management, that you're reporting if there is an ICT related incident, that you're doing testing, that you're sharing information, and that you have appropriate ICT third-party risk management. Again, not much of a step, I suppose, in some ways from a lot of the outsourcing requirements, and just with bringing the ICT domain into it. So then lastly, before I hand over to Sarah on sustainability, this kind of follows through the timeline on DORA. And I suppose the key thing here is to be aware that it has been in consultation for a number of years. The first draft publication was back in January 2024, but it comes into play now on the 17th of January 2025. So that's when it stands up, and that's when firms are expected to be compliant. And we do anticipate that there will be thematic or some kind of on-site work to ensure that firms not only have an implementation plan in place, are executing on the implementation, but then that they are following through, and that there will be embeddedness in entities. So the central bank can come in and say, what is your DORA program? And can you please show us how you have integrated this into your ICT risk management, and how, again, like I said earlier, you've evidenced the embeddedness of it. So just a very quick focus, I suppose, on some of the main elements, and I'll hand over to Sarah now on sustainability.
That's great. Thanks, Deirdre. Appreciate that. So my name is Sarah Moroney, and I'm Director in Sustainable Futures, and that's our dedicated sustainability advisory practice in KPMG. And I lead out on ESG advisory services in the Irish firm. And we thought it might be helpful today to just give a quick update on some interesting changes that are happening to the Sustainable Finance Disclosure Regulation, or SFDR. So ultimately, just a quick recap before we dive in relation to the SFDR. This is a transparency regime with a requirement to disclose how green or not funds are. And just to recap, Article 9, these are the greenest of green funds, and these funds have a sustainable investment objective. Article 8 funds are somewhat green, and they promote environmental or social characteristics. And then Article 6, none of the above, and typically so no sustainable objective or characteristics. So here we have just summarised a piece of work that was conducted by our friends in Maples Group earlier on in the summer. And it's a really interesting piece of work that looked at the Lux and Ireland markets and assessed over 26,000 funds across those markets with some interesting trends. So we obviously see an uptick year on year to the left-hand side. And interestingly for Ireland, obviously is domicile of choice for ETFs. It's a good news story there to the middle of the screen as well. And we can see that the ETF sector has really embraced SFDR, with 32% of ETFs in the sample picked by Maples Group categorised as Article 8 funds. So that's some positive messaging there. Maybe if we dig in a little bit to the right-hand side in relation to asset allocation, we can see for Article 8 funds to the upper right, ultimately equity-focused strategies dominate, and they're followed by debt, mixed strategies and ETFs, and that really follows the predominant strategies across Europe, so no real surprises there. But when you look at comparatively into Article 9, we can see a doubling up in the private assets, and this really comes down to direct control, which is required for an Article 9 fund, that control element to ensure that you are in fact green, versus the passive strategies accommodated within Article 8. To the middle of the screen then, we can see from a metric perspective what the market is up to. So considering PAIs, PAIs are essentially ESG metrics that support the SFDR disclosures. And we can see many considering those and reporting on PAIs. We also see consideration or commitment to a minimum portion of sustainable investments, again, respectable enough, and we'd hope that to improve over time. This will be a relevant metric when we come to see some of the changes coming down the tracks. But we can see, obviously, a minimum portion of taxonomy alignment, that complementary regime, the EU taxonomy. These metrics are on the floor, and they're on the floor because the data isn't currently reported, but from this year it will be. So we'd expect those metrics to improve over time And it's really a good kind of temperature check and snapshot of the trend across the Lux and Irish markets. This slide is very busy and noisy and definitely one to take away, but it just sets out the evolution of SFDR and the journey to date. So back in 2021, that legislation very much released, as we say, out into the wild, no guardrails, no data, and a lot of different clarifications, questions, etc. along the way from various market actors, which brings us to today with some of these new changes that are coming down the tracks. So if we just see some of the common critiques of SFDR just set out on the page here, based on the assessments of those key actors. So by actors, we mean the EC, the EU Commission, the Platform for Sustainable Finance, and the ESAs. Common themes here, so to the upper left, definition of sustainability. It's not consistent across the legislative framework, so between SFDR and that more detailed science-based EU taxonomy. This is inconvenient and unfortunate, and ESMA are really stating that the EUT, the EU taxonomy, should be the only show in town. A lot of work has gone into the taxonomy. It is anchored in the existing legislation, and it's the highest bar. So this is some of the messaging that's coming out from actors. Then to the middle of the screen, you can see Article 8, promoting sustainability. I mentioned that at the top of the call. There's some hot green funds. This definition is way too broad, very much open to greenwashing. And it's particularly dangerous when it's ultimately these Article 8, Article 9 disclosures are considered as de facto quality marks. And we'll see in a moment how categorisation coming down the tracks should help with that. Over to the right-hand side, the data requirements. So this is consistently a challenge, and there's a particular call out here for retail investors. Anyone who's trawled through these disclosures could really challenge the merits of much of the information that's included in them. And so very much the recommendation here from ESMA is that consumer and industry testing should be carried out pre-implementation, and really just calibrating those disclosures to the needs and requirements of retail versus institutional investors. If we look to the bottom left, we can see categorisation, obviously, as mentioned, coming through strongly and echoed across all market actors. Also this need, and this is really a grading system and understanding what those grades mean. There are various shades of green, and there is a call there for transition in particular to be considered. And we see that in the middle of the screen there. Again, what does this mean? So there are green funds, there are not green funds, there are businesses that are engaged in green activities, and then there are those that are looking to become green over time. And that's where that transition element is. And it's not captured very well at the moment, certainly in the categorisations. But one thing we would say is just to watch out for the EU taxonomy metrics. So the EU taxonomy metrics will essentially, they show revenue, CapEx and OpEx of an organisation in relation to eligibility or potentially green activities and aligned or actually green activities. And there is a bit of forgiveness in relation to revenue and OpEx, current business activities maybe not being green, but CapEx represents a real opportunity. If your business is not green yet, you can invest to become green over time. And therefore that CapEx metric is it's a very good bellwether in relation to a transitioning economy and can be used effectively considering that it's science-based and with reference to EU taxonomy criteria. And then going back to the original ask, so some of the initial challenges to SFDR straight off the bat were the PAIs, so those metrics themselves, very much environmental focused. And really the ask is to extend those and capture more of the social perspective, and also to capture that transitioning element, decarbonisation of the economy. And as mentioned, there are some helpful metrics that will improve over time to help in that regard. So on this slide here, we very much just see some of the driving forces behind the change for SFDR. So all of these market actors, and we put the headlines here, the links are there to just click and take a look in detail. But the joint ESA's opinion on the assessment of SFDR considered that product classification piece shows sustainability and transition focused classifications, that consumer testing requirements, and revisit the entire concept of what is sustainable and not. IFAMA then in the fact book, their fact book during the summer, very much giving a temperature check on industry sentiment, and again, user-friendly disclosure regime coming through very strongly, not useless data, decision useful data, please, and then less of a puzzle and more of a plan really being the strapline coming out of that document, again, calling for categorisation. To the middle of the screen there, we can see the ESMA's final report on the naming guidelines, and we'll dig into these in a moment. These guidelines essentially look for thresholds, exclusions, and in relation to the use of certain terminology in a fund name and ESG-related terminology. And we'll see what that looks like in a minute. ESMA also released their final report, greenwashing, which again is helpful. We have the definition of what greenwashing is last year, which is useful. So sustainability-related statements, declarations, actions, or communications which do not clearly or fairly reflect the profile of financial products and services. So that's a mouthful, but that's what greenwashing is. Again, after a period of consultation, we had that consensus view in relation to what it is, and then what do we do about it? And these are some of the next steps in relation to the dimensions and parameters that can be used to analyse greenwashing. And then over to the right then, we have ESMA's opinion on sustainable finance framework, so really just a reflection in relation to what can be done better over time. And again, look, this call for baseline minimum disclosure requirements, or MDRs, for all financial products. And again, categorisation coming through strongly. In case we think it came out of nowhere, we just wanted to show here some of the CBI's evolving supervisory focus on SFDR. And Déirdre has touched on some of this in her segment in relation to CSAs, etc., and various endeavours underway, and that expectation of increasing supervisory focus in this area as those regulations firm up and the new requirements come in. So we can see as early back as 2022, we had naming mentioned. So these new naming rules did not come out of nowhere. All the market signals were there that these rules were coming. We can see also reference to Article 8 guardrails, minimum sustainability criteria, and we'll see how these evolved into this guidance that's just released. Article 8.9 funds, minimum portion of investment exclusions. I'm just reading left to right here. Comments from Patricia Dunn back in the end of 2023. Quite a few speeches in this regard, touching on these topics and signalling to new requirements coming down the tracks. And then 2024, we have the recent CBI regulatory and supervisory outlook. Interesting here also a call out on green bleaching. And we'll see this when we dig into greenwashing. So the message here is it's not just about false claims, it's also about omissions. And what you don't say as well can be misleading. So green bleaching is really understating your ESG credentials in the market. So we see that often with Article 9. Do we want to say we're Article 9, for fear of being called out with the greenwashing claim? But really, central bank perspective is that understating those credentials is equally as misleading as overstating. So really just a call out on green bleaching as well. And if we move out onto the next slide, we can just dig in a little bit into these naming guidelines. So ultimately, the problem statement there is shown to the top right. It's all in a name, and this is the name is the first attribute that investors see, and it can significantly impact on investment decisions. And the regulators, they are alive to competitive market pressures and the benefits of including ESG within a name, but really the ask here and the response is to put some guardrails around that. So on the next slide, we've got a nice grid that you can take away showing what the requirements are. But you can see it depends on what the terminology is that's used. So transition, social, governance, environmental, impact, sustainability, all have different requirements, and there are common themes. But the key one is an 80% threshold requirement representing the proportion of investments used to meet environmental or social characteristics or sustainable investment objectives. So that's a pretty high bar. Comparatively, in the UK's SDR, for example, that's 70%. Right, so these are just some of the things to think about. There's also a strong prevalence of exclusions that attach to. And then specifically for sustainability related terms, there's an extra requirement to commit to invest meaningfully in sustainable investments. And this is a lighter touch requirement in line with the initial SFDR definition, no metric or threshold set, which is likely to be a challenge over time, but we have helpful metrics and guardrails in relation to the 80%, and we'll see the screens in a moment to tether our approach going forward. There are challenges with timing in particular. So the two options are, right, okay, am I going to change the name or am I going to change my strategy? So each have challenges. And in relation to changing the strategy, you've got the rebalancing cycle within your fund cycle and the potential triggering of additional fees if those rebalancing cycles and name-changing rule meeting the name-changing rules aren't aligned from a time perspective. And then secondly, you've got in relation to changing the name, some regulatory forbearance. There is a call for that in relation to fast-tracking the product name-changing process. So we see the timelines to the left-hand side. The guidelines were published in August, right? And for new funds, the guidelines are triggered from 21 November this year, but there are an extra 6 months out to May 2025 for existing funds to meet the guidelines as they're set out. This is the grid or the template that can be a useful reference in relation to the use of those terms listed to the left, requirements shown in the grid. And you'll see this kind of grading in relation to exclusions. The exclusions are tethered to benchmarks, and the requirements and the exclusions for each benchmark are set out to the right-hand side. So we've got the higher bar of the Paris-aligned benchmark with more exclusions, and then we've got the climate transition benchmark, or CTB, with less exclusions. But again, you can see them applied then across the various names. Interestingly, for impact, along with financial return, there's also that positive and measurable social and environmental impact. And this measurability is really important when it comes to impact. We see that echoed there into transition as well. Clear and measurable path for S or E transition, and this really data driven when it comes to measuring progress over time. We mentioned greenwashing as well, and the final report from ESMA in relation to greenwashing, and this essentially looks at the supervisor role in mitigating greenwash, and it sets out a number of core considerations which can be adapted across sectors, and also looks at NCAs. Some of the key themes here, and you'll see, the dimensions and parameters that can be used to assess greenwashing, but on a step back, the key messages are there can be misleading communications due to omission or provision of incorrect information, as we mentioned previously in the greenwash, green bleach reference point. Also misleading claims, whether they're intentional or unintentional, that needs to be considered. Misleading actions, not taking client perspectives into account. Greenwashing itself can occur at an entity, product or service level, including giving of advice, and it can occur at any stage and also within disclosures. And then all of these considerations from across all the actors, all those driving forces of change in relation to product categorization, for example, naming rules, these greenwash guardrails, these can be boiled down into 3 best practice building blocks, and we've shown those to the base of the screen here. So disclosure obligation, product labels and standards, and marketing restrictions. And we can see that direction of travel using those building blocks from SFDR 1.0, what was, and then this potential future state where we're headed towards with all of these new emerging requirements. So we can see the adding in there of product labeling regimes, and also in the purple then the greenwashing recommendations and those naming restrictions. And then we see an emerging theme in the market, development of sustainable investment frameworks, which is great and welcomed. That's fantastic. A word of caution in relation to just embarking on this journey. Yes, the building blocks are there, which is helpful. It's the order that can be a sticking point. So the inclination might be let's start with disclosures and work our way back. Ultimately, we're ticking a box on disclosures and we're working back. But very much what we find is that to build an agile framework that can work across certain markets and exploit efficiencies between markets, it's reversing the order, starting with product and then building towards disclosure and market restriction. So product, building in those thresholds that I mentioned on the previous slide, building in the naming rules, early doors, building in the governance on data, and then building up into a compliance-ready disclosure, and also having already met just naturally and holistically met the marketing restrictions from that bottom-up approach, starting with the product. And then what we've just set out here is essentially some steps that you can take as you're building your own compliance frameworks to deal with these new requirements. And there's three, again, modules here. So legal documents, processes and systems, and investment strategies. And again, we'd recommend to build that foundation at a product level, and then it just, again, manifests as a robust disclosure that meets the compliance requirements. And again, take away, this is something as you're building up that go-forward compliance strategy for SFDR 2.0, just to consider those modules and steps, bearing in mind the building blocks, and think about being agile across markets and not having to reinvent the wheel to meet competing thresholds. So hopefully all was clear on that. I know that you'll get the slides to take away, and I'm just going to pass back to Conor.
Thanks very much, Sarah, and thank you to Déirdre as well. And thanks to you all for joining us today. We hope you found some aspects of this useful for your future needs. As Sarah alluded to, the slides are going to be available a lot, as well as the recording of today's session, I believe from tomorrow, if there's any more detail that you wish to explore. Déirdre, Sarah, and I are more than happy to answer any questions or to help you with a particular problem or project that you might have. So please reach out to us as you digest today's session if there's something that we can help you with, or if you'd like to learn more. And apart from that, a big thank you from KPMG for joining today and wishing you a good day.